What is going on, guys? Welcome back to the channel. My name is Tyler. We are talking credit default swaps in this video, specifically United States credit default swaps and Chinese credit default swaps. If you guys are unaware of what CDSs are, this was used in The Big Short, the movie, and the big trade Michael Burry did have. This is a great level of, gauging the fear of institutional investors, and we are seeing these going absolutely crazy. We are at our levels of February 2020. So this is definitely showing some signs of instability in the financial markets, as well as a lot of fear that is going on in our markets. So we're going to get into that, as well as what the current situation is for the overall markets, what investors are really worried about, what they are paying attention to, and when this could eventually go away or all come crashing down. So drop that like on the video, consider subscribing to the channel, hit me down below in the comment section. What do you guys think about this information? And with that, let's get into this video. So to even talk about credit default swaps, you have to know what a credit default swap is, and that's what we're going to first talk about. So what is a credit default swap? A credit default swap, or just in parentheses CDS, is a financial derivative or contract that allows an investor to swap or offset his or her credit risk with that of another investor. For an example, if a lender is worried that a borrower is going to default on a loan, the lender could use a CDS to offset or swap the risk. Now, to help this make more sense to you guys, we're going to go ahead and read this paragraph right here. The payment received is often substantially less than the face value of the loan. Credit default swaps in their current form have existed since the early 1990s and increased in use in early 2000s. CDSs are not traded on an exchange, and there is no required reporting of transactions to the government agency. So that is really why it's so hard to get your hands on accurate data for CDSs. The Bloomberg terminal does have probably the most accurate CDS numbers, and that's really what we're going to take a look at in just one second. Now, as far as Michael Burry is concerned, if you guys are just wondering or curious, if you guys have seen The Big Short, then you know he used credit default swaps, and this is something you really have to go to a bank to do, or if you're a hedge fund, it's easy to do with other banks or other parties. It's basically insurance. It's like buying calls or selling calls, or buying puts to insure or protect your positions. Now, Michael Burry's CDS trade, Michael Burry was able to do so by buying credit default swaps, a financial swap agreement where the seller of the CDS agrees to pay the buyer in the event that the debit defaults. It's basically buying insurance on an asset default. So it's basically insurance. But it really shows the institutional fear levels and what they are thinking is going to happen. Now, let's get into these actual images that I do want to point out for you guys. So here is the US credit default swaps, and this is the 5-year chart, as you can see from the picture. You can find these images on Google and all that if you guys are curious. It's going to be a little bit hard to find just because the data is not readily available, but this is the 5-year chart. As you guys can see right here, this is March of 2020. We are at it looks like 1775 right now. This is where we were right before March of 2020. So I think a lot of institutional investors put us at that similar moment right before you knew shit was about to hit the fan. Basically, best way to say it, you knew right before you knew shit was about to hit the fan, and you didn't want to go too crazy with credit default swaps, but you want some level of protection. And if you could draw a line right here, it's literally right here in about February of 2020, right before March. Obviously, these about doubled from where they were currently at to about March. So definitely showing a lot of fear in the overall markets in the US, and the US investors, they use credit default swaps a little bit more. As you guys can see from this next image, we'll go ahead and pull that up right now. This is the Chinese credit default swaps, and you guys can see, actually, I will go ahead and do that. You guys can see that it's the same thing, the 5-year chart, but in China, they really wait till the last second to buy these credit default swaps. We're pretty much at the same level we were in February of 2020, but we're waiting to see if more institutional investors do start to buy these swaps. All in all, this is really giving you guys a good reference of where the fear level is, regardless of if the markets are bouncing and we're up. Like right now, what are we up? We're up like 1.5% in the overall markets across the board. NASDAQ up almost 2%. So do not let this fool you. It's not all doom and gloom, specifically with AMC, just because if the markets do sell off, that's when you're going to see the MOAS. AMC is going to sell off as well, but it's going to get to an inflection level, just like Volkswagen in 2008. You go down, they went down about 50% until all the liquidity was basically dried up. They had a big announcement that Porsche was buying a majority stake of Volkswagen, and then the short sellers, they didn't have enough money to deposit into their collateral positions for those short positions in Volkswagen, and then they were ultimately forced to cover. So that is the same situation that would happen with AMC, but this all could take some time. It could go faster, it could take more time. We're going to talk about what is going to come faster, what could take more time. Now, the thing that would affect the markets first, and by far be the worst thing that could possibly happen, is going to be the US if they did default. We have raised the debt ceiling or suspended this 80 times in the past, so I don't think it's going to happen. But even if we drag this out and we come dangerously close, then we could get our credit downgraded, which will definitely hurt the markets as well. Given the over leveraging, just a credit downgrade could have terrible effects on the stock market. Janet Yellen did also come out to say today that she fully expects a default would cause a recession as well. So that's going to be coming on October 18th. Obviously, a credit downgrade would probably come by October 15th if we didn't have the debt ceiling raised. Somewhere around there, they're going to default, or not default, but definitely give us a credit downgrading, which would definitely not be a great thing whatsoever. Now, second thing up that is happening is that a lot of investors are getting ready for the meeting of Fed Jerome Powell coming on November 3rd, where he is widely expected to announce tapering. And I think investors are kind of pricing this in, so I don't think it's going to be a huge impact, but it could definitely make the bonds move and definitely have an impact to interest rates, which could slow down the economy, as it is already slowing down a little bit as we are being reported the data. Those are the real two near-term things, but really the biggest thing above all of this, because I don't think these two things, the debt ceiling or, starting to taper, is going to be a big deal in the longer term. It is going to be the Chinese real estate market, which accounts for about 15 to 25% of the total GDP of China. We now have 3 property developers that are in serious trouble. And obviously we have Fantasia Holdings, which did miss repaying the principal amount of $206 million on a bond that matured on Monday. It said in a filing to the Hong Kong agency. As well as that, we do have another one that is in very bad situation. I gotta find it for you guys. Let me see. This is a very long article, but it is right here. S&P Global Ratings lowered its rating on Cynic, saying it had to run into a severe liquidity problem and its debt servicing ability has almost been depleted. It said the firm was likely to default on notes totaling $246 million due on October 18th. So definitely not a great situation. And then obviously we have Evergrande as well as that. Evergrande is going to be the biggest issue, but what I want to know is that this is going to take a long time to eventually play out. Now, Evergrande is trying to do something. They're trying to raise about $5 billion. We're going to go ahead and read this paragraph right here. The $5 billion Evergrande is likely to get from the reported stake sale would theoretically cover its near-term offshore bond payments. It has $500 million in bond coupons due by year end, followed by a $2 billion bond maturity in March, and that's obviously March of 2022. So this could take a while. It could drag out for a long time. Lehman Brothers, they started having financial issues in August of 2007 with the failure of 2 Bear Stearns hedge funds. During that month, the company eliminated 1,200 mortgage-related jobs and shut down its BNC unit. This was the first sign of trouble back here in August 2007, but they actually didn't declare bankruptcy up until September of 2008. So that was, about 13 months later. So we're definitely looking at some pain in the markets, in my personal opinion, over the next year and a half, maybe sooner than that, maybe, mid 2022. That's kind of where my timeline of this would be. Obviously, who knows what'll happen with AMC in the meantime. I like to think that we won't be here talking about AMC by the mid 2022, but there is a decent chance we may be here talking about this still in 2022. So definitely going to have an impact. Obviously, if we default on our debt, that's a worst case scenario, and we should know something very soon, as it is October 5th currently. So that is all for this video. Hopefully you guys get an insight to what is going on with the credit default swaps, as well as what are the major concerns for the markets at the current time. So drop that like on the video, consider subscribing to the channel, as well as let me know down below in the comment section what you guys think about all of this information. And just for some people that like to comment and say, if the stock market went down, AMC would fall as well. Yes, AMC would fall. They would fall. Maybe, probably 50% in value, take us down to $20, and then once the markets are at the bottom, we're like a, you know, gasoline and a fire at that point to see a short squeeze, because the hedge funds, they don't have that money to stay in their short positions once that position starts to go against them. So that is the theory there. Hopefully you guys got some value out of this video. Like I said, if you guys want to directly support the channel, links for free stock down below in the description to do so, as well as a link for the buy and sell alerts. We do it all. We swing trade, day trade, make long-term investments with stock, options, and crypto. So definitely a great place to be. If you guys want to be a part of it, check it out. Link down below in the description. It pays for itself, and we keep it very inexpensive, so anybody is financially able to join if they want to be a part of that. So stay tuned for follow-up videos. That is going to be all for this video. I will see you in the next one.